Today, we are embarking on a massive, deep dive into what is universally considered the ultimate Bible of charting and trading. We are completely unpacking technical analysis of the financial markets by the legendary John Murphy. If you have ever opened up a broker account, stared at a stock chart, a cryptocurrency pair, or a forex chart, and felt completely overwhelmed by the chaotic, squiggly lines and colorful bars, you are absolutely in the right place today. Grab a cup of coffee, get very comfortable, and let us embark on a storytelling journey to decode the secret language of the financial markets together. This is not just going to be a dry, boring textbook review. We are going to translate Murphy's lifetime of work into a practical, actionable story that you can use to radically transform the way you view and trade market movements forever. By the end of this video, you will have a comprehensive understanding of price action that usually takes novice traders years of painful trial and error to figure out on their own. Let us get right into it. The core philosophy of technical analysis, the entire premise of John Murphy's book, and honestly the entire discipline of technical charting itself, rests on three massive philosophical pillars. You absolutely must understand these before you draw a single line on your screen. The first and most important pillar is that market action discounts everything. This simple phrase means that all the breaking news, all the quarterly earnings reports, all the fundamental economic data, the geopolitical fears, the inflation rates, and the broad macroeconomic shifts are already fully reflected in the current price of whatever asset you are looking at. You do not need to be a Wall Street insider to know what is fundamentally happening behind closed doors. You just need to look at the price on your screen. If the price is aggressively going up, the buying demand is simply higher than the selling supply, regardless of what the gloomy news anchors are screaming on television. The second foundational pillar is that prices move in trends. A market trend in motion is far more likely to continue in its current direction than it is to suddenly reverse. I want you to think of a major trend like a massive, heavy freight train barreling down the tracks. Once that train gets moving in one direction, it takes an enormous, almost incalculable amount of energy and time to slow it down, stop it, and completely turn it around. Our primary job as retail traders is never to stand bravely in front of that speeding train. Our job is to simply hop on board and ride it for as long as it safely goes. The third pillar is that history consistently repeats itself. Human psychology fundamentally does not change. Deep-seated emotions like overwhelming greed, paralyzing fear, and widespread panic have driven human market behavior for centuries, and they will continue to do so until the end of time. Because human behavioral reactions are entirely repetitive, the visual footprints they leave behind on a price chart are also highly repetitive. When we take the time to study historical price patterns, we are not just looking at dead data. We are actively studying the psychological blueprint for the future. The foundation built by Charles Dow. Long before modern computers existed, Charles Dow was laying the groundwork for everything we do today. Dow is widely considered the grandfather of technical analysis. Murphy passionately explains that understanding Dow Theory is exactly like understanding the alphabet before you attempt to write a complex novel. Dow observed that the market essentially has three main trends, and he compared them to the ocean. The primary trend is the granddaddy of them all, lasting anywhere from several months to several years. This represents the actual tide coming in or going out at the beach. Then, you have the secondary trends, which act exactly like the waves rolling in on top of that tide. These are shorter-term market corrections that briefly retrace a certain portion of the primary trend before the main direction resumes. Finally, you have the minor trends, which are just the tiny, insignificant ripples on the surface of the water, lasting only days or weeks. To be consistently successful, a trader must absolutely know which of these three trends they are currently trading, so they do not mistake a mere ripple for a massive tidal shift. Dow also taught us a crucial lesson: volume must confirm the trend. If the broader market is rising in a healthy uptrend, the trading volume should naturally increase as prices push higher and decrease when prices temporarily fall. If prices are pushing to brand new highs but the overall volume is actively shrinking, the market is completely running out of gas. This divergence is a massive, blaring alarm that a painful reversal might be imminent. Dow also insisted that different market averages must fundamentally confirm each other. In his specific era, he relied on the industrial average and the railroad average. Today, you might watch the S&P 500 and the Nasdaq tech sector. If one major index is hitting new all-time highs while the other is heavily lagging behind, it is a structural warning sign that the overall foundation of the market is currently incredibly weak. Understanding the lifeblood of markets, the trend, let us talk deeply about the specific concept of the trend. A trend is never just a perfectly straight diagonal line drawn on a chart. It is an evolving series of market peaks and market troughs. A valid uptrend is strictly defined as a series of higher highs and higher lows. Every time the market dips, buyers step in at a higher price than the last time, proving their unrelenting eagerness. A valid downtrend is a depressing series of lower highs and lower lows, where sellers are aggressively dumping their shares at increasingly cheaper prices just to get out. When the market moves purely sideways with equal highs and equal lows, we call it a trendless market, a consolidation phase, or a trading range. Within all of these unfolding trends, we find the critical invisible barriers of support and resistance. Support is a specific price level where buying interest is strong enough to physically interrupt or completely reverse a painful downtrend. Imagine it as a concrete floor made entirely of eager buyers who are willing to desperately catch the falling price. Resistance is a price ceiling where selling pressure is strong enough to immediately interrupt or reverse a joyful uptrend. Imagine resistance as a thick glass ceiling where trapped sellers are anxiously lurking, ready to dump their shares at break-even and brutally halt the upward momentum. The absolute magic of technical analysis happens when a major support or resistance level is decisively broken. According to Murphy, once a solid resistance level is completely shattered by aggressive buyers, it undergoes a psychological role reversal and becomes the brand new support level. The old ceiling literally becomes the new floor. Conversely, a shattered support floor transforms into a brand new resistance ceiling. This fundamental role reversal is one of the most powerful, highly reliable concepts you can instantly apply to your own trading routine right now. The art of spotting reversals. Chart patterns are simply undeniable pictures of raw human psychology painted on a digital screen. Murphy details quite a few major reversal patterns, but the absolute undisputed king of them all is the infamous head and shoulders pattern. Picture this intense scenario in your mind. The market pushes to a new high on great optimism, followed by a minor pullback as early buyers take profit. That forms the left shoulder. Then, fresh enthusiasm drives the market to an even higher, euphoric high, followed by another sharp pullback. That massive peak forms the head. Finally, the market rallies a third time but miserably fails to reach the euphoric high of the head, and it pulls back once again. That weaker peak forms the right shoulder. If you draw a horizontal or slightly angled line connecting the lowest points of those two pullbacks, you get what is called the neckline. When the asset price violently breaks down below that fragile neckline, it signals a massive structural shift in market psychology. The once dominant bulls are utterly exhausted, and the aggressive bears have officially taken the steering wheel. Another major, highly watched reversal pattern is the double top, which visually looks exactly like the capital letter M. The eager market tries twice to break through a heavy resistance ceiling and fundamentally fails both times, leading to a massive sell-off. On the flip side, we have the double bottom, which visually resembles the capital letter W. In this bullish scenario, the battered market finds concrete support twice at the exact same price level before violently blasting off to the upside. Recognizing these psychological patterns in real time gives you a massive, unfair advantage over the casual retail crowd, because they literally scream out precisely when the market tide is finally turning. Pauses in the market. Continuation patterns. Not all chart patterns signal a brutal reversal of fortune. Very often, a trending market simply needs to pull over and catch its breath before actively resuming its primary direction. These healthy rest stops are broadly categorized as continuation patterns. The most common and reliable continuation patterns you will encounter are symmetrical triangles, bull flags, bear flags, and pennants. A symmetrical triangle occurs when the market makes a series of lower highs and higher lows simultaneously, slowly coiling up the price action like a tightly wound metallic spring. The kinetic energy in the market is visibly compressing, volatility is rapidly dropping, and eventually, that massive stored energy absolutely has to forcefully release. Usually, this explosive release happens aggressively in the exact direction of the prior established trend. A traditional flag pattern looks exactly like a fabric flag hanging on a tall pole. The flagpole itself is a sharp, nearly vertical, explosive price movement, which is then immediately followed by a slow, slight downward drifting channel, which is the flag itself. This tedious downward drift represents incredibly healthy profit-taking by the very early, smart money buyers. Once the upper boundary of that flag is violently broken to the upside, the original aggressive trend resumes with an absolute vengeance. Pennants are functionally very similar to flags, but instead of a parallel downward channel, their boundaries briefly converge like tiny, fast-forming symmetrical triangles. What makes all of these continuation patterns ridiculously powerful for you as an active trader is that they offer a beautiful, mathematically low-risk entry point into an already established, highly lucrative trend. You are never trying to foolishly pick a dangerous market top or catch a falling knife at the bottom. You are intelligently just waiting for the market to politely finish its rest stop before you happily hop back into the fast lane of the highway. The fuel of the market, volume and open interest. Murphy makes it abundantly crystal clear throughout his entire book. that raw price action is not the only thing you should be intensely watching. Volume is the literal combustible fuel that actively drives the market engine forward. Whenever you physically see a major price breakout, whether it is tumbling down from a massive head and shoulders neckline or exploding upward from a tight bull flag pattern, you absolutely must immediately look down at the volume bars. A price breakout that occurs on massive, unusually high volume is structurally valid and highly trustworthy. It firmly proves that massive institutional money, massive hedge funds, and widespread retail participation are all actively driving the violent move. A price breakout that weakly occurs on very low, pathetic volume is highly suspicious, fundamentally untrustworthy, and very often leads to a painful bull or bear trap. It mathematically proves that the move completely lacks true underlying conviction. For those of you who eventually move on to trading futures contracts or complex options, open interest becomes another profoundly crucial analytical tool. Open interest strictly represents the total running number of outstanding active contracts that have not yet been settled or closed out by market participants. If asset prices are aggressively rising and the open interest is also simultaneously rising, brand new institutional money is confidently entering the market, which is incredibly bullish. If prices are rising but open interest is actively falling, the market rally is merely being driven by panicked short covering, not brave new buyers, meaning the current upward trend is very likely nearing its exhausting final end. By properly combining price, volume, and open interest together, you unlock a beautiful, three-dimensional X-ray view of the ongoing market battlefield, smoothing the noise with moving averages. Let us shift our focus to moving averages, which are undisputedly the ultimate, time-tested, trend-following tools in existence. They gracefully smooth out the erratic, incredibly chaotic daily noise of the market and beautifully reveal the true underlying directional path of the asset. The simple moving average mechanically calculates the average closing price over a very specific, predetermined number of time periods. For example, a 200-day moving average literally adds up the closing prices of the last 200 days and divides that total by 200. This mathematical line acts as a massive, dynamic, curving support and resistance barrier. Countless massive institutional investors and global portfolio managers use the highly respected 200-day moving average to broadly define whether we are globally in a long-term bull market or a devastating bear market. On the other hand, the exponential moving average puts significantly more mathematical weight on the most recent price data, making it far faster and much more sensitive to sudden, violent price changes. One incredibly popular, highly effective strategy that Murphy discusses in heavy detail is simply using two moving averages of entirely different lengths on the exact same chart. When the faster, shorter moving average violently crosses above the slower, longer moving average, it triggers a powerful mechanical buy signal. In the financial media, this is universally known as a golden cross. Conversely, when the shorter moving average miserably crosses strictly below the longer one, it triggers a mechanical sell signal, ominously known as a death cross. Moving averages can never magically predict the future, but they ruthlessly ensure you are practically always trading safely on the correct side of the dominant market trend, reading overbought and oversold extremes. While moving averages are absolutely phenomenal for clearly trending markets, they fail incredibly miserably in choppy, sideways, consolidating markets. This is precisely where market oscillators come into play to save the day. Oscillators are complex mathematical indicators that are visually plotted below the main price chart, and they endlessly fluctuate back and forth within a strictly bounded numerical range. They heavily assist you in correctly identifying extreme overbought and heavily oversold market conditions. The Relative Strength Index, originally developed by the brilliant Wells Wilder, is arguably one of the most famous and widely used oscillators on the entire planet. It specifically measures the sheer speed and the internal change of price movements on a rigid scale, stretching from 0 up to 100. A reading firmly above 70 strongly suggests the underlying market is heavily overbought, incredibly extended, and a painful downward correction might be immediately due. A reading deep below 30 strongly suggests the market is deeply oversold, washed out, and a violent upward bounce might be extremely imminent. However, Murphy issues a massive warning that countless beginners tragically ignore. In a furiously strong uptrend, an oscillator can stubbornly stay overbought for an incredibly long, painful amount of time. The real, hidden secret to using oscillators effectively is hunting for hidden divergences. A bearish divergence dangerously occurs when the asset price makes a brand new higher high, but the underlying oscillator weakly makes a lower high. The internal momentum is literally dying, even though the surface price is actively rising. This is a massive, screaming red flag. A bullish divergence beautifully happens when the raw price makes a depressing lower low, but the underlying oscillator bravely makes a higher low. The relentless selling pressure is finally exhausting, and a massive relief rally is extremely likely lurking right around the corner. The elegance of Japanese candlesticks. John Murphy was highly instrumental in helping popularize ancient Japanese candlestick charting in the modern Western world. I can personally promise you that once you start genuinely using them, you will honestly never want to look at a boring, standard Western bar chart ever again. Candlesticks provide a visually stunning, deeply insightful representation of the vicious, ongoing battle between optimistic buyers and pessimistic sellers within any given time frame. The thick, wide part of the candlestick is officially called the real body, and it distinctly highlights the exact price range between the opening bell and the closing bell. The thin, wiry lines sticking out above and below the real body are called the shadows, or wicks, showing the absolute extreme high and extreme low of that specific trading session. If the closing price is significantly higher than the opening price, the real body is usually colored bright green or pure white, aggressively showing complete bullish dominance. If the close is much lower, it is colored deep red or pitch black, showing brutal bearish dominance. The actual physical shapes of these unique candles tell incredibly profound stories. A doji is a unique candle where the opening and closing prices are almost exactly identical, creating a distinct cross-like visual shape. It visually represents total, paralyzing indecision in the market battlefield. A hammer candle features a tiny real body and an unusually long lower shadow. It clearly tells us a vivid story. Aggressive sellers ruthlessly pushed the price way down during the session, but relentless buyers completely overpowered them and bravely drove the price all the way back up near the top by the closing bell. When you intelligently combine these emotional candlestick patterns with traditional Western technical analysis like horizontal support and resistance, you organically create an incredibly potent, highly accurate trading strategy. The ultimate key to survival: money management. We have extensively covered a massive amount of technical charting tools today, but I need you to listen to me very closely right now. Absolutely none of these amazing tools matter at all if you do not deeply master the final, most crucial chapter of Murphy's philosophy, which is strict money management and bulletproof trading psychology. You can easily have the absolute best charting skills in the entire world, but if you foolishly risk way too much money on a single, isolated trade, you will inevitably, unavoidably blow up your entire trading account. Murphy heavily emphasizes that strict capital survival is your absolute first, foremost, and primary goal as a professional trader. Making immense profits strictly comes second. You should fundamentally never, ever risk more than a tiny, fractional percentage of your total trading capital on any single market idea. He highly suggests mechanically using a strict risk-to-reward ratio of at least 1 to 3. This mathematical rule means for every single dollar you brave enough to risk losing, you absolutely must aim to make $3 in potential profit. If you rigidly stick to this cold, unfeeling math, you can literally be entirely wrong on more than half of your daily trades and still be incredibly profitable at the end of the calendar.